Welcome back to The Explainer. So this week we're tracking a really fascinating, honestly kind of massive shift in the financial landscape. We're unpacking the KINGFINITY Portfolio Sentiment update for the week ending Friday, June 26, 2026. Look, if you've been watching the markets lately, you know it's been this wild ride of high-growth tech speculation, right? But this week, the narrative completely fractured. We are literally witnessing what you could call the Great Rotation. It's this massive strategic movement of capital pivoting away from those flashy, margin-pressured tech names and flowing directly into defensive, cash flow-driven investments. It's the classic pivot from offense to defense, and today we're going to explore exactly how and why this is all unfolding. Okay, let's dive into this. Here's our agenda for today. First, the weekly market snapshot, then the AI cost shock, followed by the defensive rotation, utilities and healthcare resilience, and finally, next week's watch list. Section 1, the weekly market snapshot. So, checking out the KINGFINITY Portfolio Sentiment update for the week, the big themes jumped right out. AI cost shocks and a massive defensive rotation. But honestly, beneath those headlines, the actual market numbers were just soft. Across the board, leadership really faltered. We saw the Dow Jones close down 0.1%, the S&P 500 slipped 0.1%, and the Nasdaq took a 0.2% hit. In fact, both the S&P 500 and the Nasdaq posted outright weekly losses. That tech sector, the one that's been the absolute darling of the market, it remained under some incredibly heavy pressure. Basically, capital was desperately looking for a reason to de-risk, and, well, the macroeconomic data totally gave them one. And let's talk about the hard data anchoring all that market anxiety. The Bureau of Economic Analysis reported the May PCE, that's the Personal Consumption Expenditures Price Index, at a headline number of up 4.1% year over year. But even more crucially, the core PCE, which strips out those really volatile food and energy prices, just sat there at a super sticky 3.4%. I mean, these are absolutely not the kind of numbers that suggest an imminent easing of monetary policy, right? Because inflation is staying so central and so persistent, it's really weighing on everyday consumer sentiment and, of course, keeping that whole Federal Reserve rate conversation very much alive. This data keeps rate expectations incredibly tense across Wall Street. It puts rate-sensitive sectors squarely in the crosshairs and makes investors, frankly, super nervous about holding on to overpriced volatile assets. Section 2, the AI cost shock. And there's a brilliant contrast that perfectly illustrates the stark divide that opened up in the market this week. On one side, you've got the pressure points, heavyweights like Apple and the major semiconductor players. These AI-linked tech and hardware names just faced intense selling pressure, all stemming from component cost and memory chip concerns. But then, on the flip side, we have our positive signals, names like American Electric Power and Johnson & Johnson. These are the defensive, rate-sensitive quality pockets that investors actively rotated into. Like, growth leadership is still fundamentally important, sure, but the market's patience, it's definitely wearing thin. Let's look specifically at Apple for a second. Apple was heavily pressured this week by reports that they're actually increasing prices for MacBooks and iPads. But, it's the why that really spooked the market. These price bumps are directly tied to soaring memory and storage costs, which are driven by this massive AI infrastructure build-out. It's kind of ironic, right? AI was supposed to be this ultimate cost saver, but right now, it's costing tech giants an absolute fortune in hardware. The broader market read-through here is just massive margin pressure across all AI-exposed hardware. We're all realizing that the AI boom isn't just this pure growth story anymore. It has rapidly evolved into a margin and consumer price story. Can these companies actually pass these costs on without totally crushing consumer demand? That specific uncertainty triggered some serious fragility and volatility this week for semiconductor and memory names like Qualcomm, Texas Instruments, and even Cisco, which, by the way, saw downside pressure despite previously reporting record revenue. So with inflation running this hot and the biggest tech companies in the world facing a literal AI cost shock, we have to ask, in a noisy market, where does capital find shelter? I mean, when the high flyers start looking precarious, where do the smartest investors park their money? Section 3, the defensive rotation. Well, as capital fled that tech volatility, it strategically shifted into stable, highly resilient areas. It's a classic defensive rotation right into healthcare and consumer staples. We're talking about the essentials, things people need regardless of what the broader economy is doing, food and medicine. This is exactly why we saw these strong pockets of defensive buying in staples this week. Names like Kraft Heinz rebounded over 2% on Thursday, and General Mills gained nearly 1.7% ahead of its upcoming earnings. Suddenly, the market is craving earnings discipline and margin stability way more than hype and spectacle. And honestly, there is absolutely no better proof of that craving than Johnson & Johnson's Friday closing price, $253.09. J&J became a massive beneficiary of this rotation. It really strengthened its defensive bid as investors just aggressively bid up its fortress-like healthcare balance sheet. Think about it. When you see a legacy name like J&J stringing together strong sessions and closing at a premium in an otherwise down market, it's a glaring signal that capital is prioritizing shelter. They aren't looking for massive overnight gains right now. They are literally just looking to protect what they have. Section 4. Utilities and Healthcare Resilience. Now, while the tech world was panicking over memory chip costs, the utilities sector was projecting absolute calm. American Electric Power, or AEP, and Xcel Energy were some of the clearest defensive signals of the entire week. AEP actually gained over 1.5% on Thursday alone, pushing it super close to its 52-week high, and massively outperforming in what was otherwise a really mixed market. Why? Simple. Regulated cash flow visibility. In a noisy, highly unpredictable market, the ability to forecast exactly what a utility company is going to earn next quarter becomes incredibly valuable. It acts as an anchor, a portfolio stabilizer. Even with those elevated interest rate risks looming in the background, investors chose the predictability of utility bills over the wild uncertainty of AI hardware margins. And if we zoom out to the global macro level for a minute, we see some other factors supporting this cautious positioning. In the energy markets, oil eased up quite a bit. WTI crude fell back below $70 a barrel, and Brent hovered near 72 as supply fears in the Strait of Hormuz kind of moderated. This lower oil price actually helped cool the geopolitical risk premium, bringing it back down near pre-war levels. Meanwhile, over in Europe, the focus remains super glued to banking and credit risk. The market is closely monitoring Unicredit as an event-driven signal, mainly due to its Commerzbank takeover process and the political resistance popping up in Germany. On top of that, the European Central Bank's June rate increase keeps European bank net interest income and overall credit risk squarely in focus. It's this incredibly complex global web, and right now, all of it is driving capital straight towards safety. So the crucial point is perfectly summarized by this quote from the KINGFINITY Portfolio Update, signed by the Queen Maker. This was a week of capital choosing shelter over spectacle. I mean, I absolutely love that phrasing. It just perfectly captures the entire philosophy of the past 5 trading days. Yes, the portfolio's technology names still carry massive long-term strategic relevance for sure. But for the near term, the crown fully belonged to resilience. Healthcare balance sheets, regulated utilities, staples earnings discipline, and energy infrastructure cash flow. Spectacle is great for bull markets, but shelter is how you survive the uncertainty. Section 5. Next week's watch list. All right, let's look ahead. Keep your eyes glued to these upcoming market catalysts. First up, we've got major consumer staples earnings that could really validate this defensive rotation. General Mills reports its fiscal Q4 and full-year results on July 1st. Right after that, PepsiCo reports Q2 results on July 9th. We really need to listen closely to their commentary on consumer demand, pricing, and margins. Second, continue monitoring that AI hardware inflation and memory chip cost issue for the big players: Apple, Microsoft, Qualcomm, and Cisco. Third, keep a really hawkish eye on U.S. interest rates following that 4.1% headline PCE inflation data we talked about. Watch exactly how rates impact our newfound safe havens, specifically those utilities, REITs, and dividend names. And finally, track the oil markets and Middle East shipping risks. Names like Chevron and ONEOK. Actually, ONEOK showed some really nice late-week strength and raised its 2026 guidance. They're going to move on any major shifts in crude prices. Which brings us to our final overarching thought for this explainer. The market is very clearly demanding proof right now. Proof that all this massive AI spending can actually translate into bottom-line earnings without completely damaging corporate margins. And honestly, until that proof arrives, we have to ask. If the market now demands proof that AI spending can translate into earnings without damaging margins, is this defensive rotation, this flight to utilities, healthcare, and staples, just a temporary shelter from a passing storm? Or are we actually looking at the new foundational structure of the market for the second half of 2026? It's a vital question to consider as you review your own holdings this weekend. Thank you so much for joining me to unpack these dynamics today. Stay focused, stay disciplined, and I will see you in the next explainer.